The purpose of central banks isn't to protect you, it's to protect the banking system. As global uncertainty rises and the dollar's stability comes into question, one investment has emerged as the ultimate wealth preserver: gold. While stock markets experience dramatic volatility, with trillions erased in mere hours, gold has surged nearly 30% year-to-date, hitting its 55th record high in just the last 12 months. Even as tariff tensions escalate with China and global economic uncertainty persists, gold continues its historic climb. With analysts now projecting gold could reach as high as $5,000 an ounce, let's examine why investors are flocking to this safe haven asset, how it's becoming 2025's best performing investment, and whether you still have time to benefit from this rally. Despite gold now outperforming the stock market over the last 8 years, there are important risks every investor should understand before making decisions. If you find this analysis helpful, please hit the like button and subscribe for more financial insights. I read all comments and respond to as many as possible. To understand gold's current popularity and potential, we need to explore its unique history. Unlike fiat currencies that can be printed at will, gold has served as legitimate currency for thousands of years. It's scarce, doesn't degrade, remains easily moldable, and is remarkably rare. All the gold ever mined would fit inside a 23-meter cube. In the United States, gold formally entered the financial system in 1792 when Congress passed the Mint and Coinage Act, creating gold and silver coins in various denominations. This eventually led to the gold standard, where paper currency could be redeemed for physical gold at guaranteed rates, facilitating global trade without physically transporting heavy gold bars. This system functioned well until the Great Depression. In 1933, as citizens rushed to exchange paper money for physical gold, bank reserves depleted rapidly. President Roosevelt responded with Executive Order 6102, banning private gold ownership and requiring citizens to surrender their gold for paper currency. This concentrated the world's largest gold stockpile in U.S. government hands. After World War II, most countries pegged their currencies to the dollar because American currency was backed by gold until it wasn't. By 1970, the Vietnam War had devastated the U.S. budget, and global gold demand outpaced what any reasonable currency system could support. To inject more money into the economy, the dollar was disconnected from the gold standard, allowing the government unprecedented monetary freedom. From this point forward, our money's value relied solely on collective belief in its worth. Gold prices soared from $35 an ounce in 1970 to $594 by 1980, equivalent to $2,445 in today's inflation-adjusted dollars. As the dollar subsequently stabilized, gold prices flattened until recent years, when increased money printing has consistently gold to new heights. So is gold a worthwhile investment? Since abandoning the gold standard, the dollar has lost 85% of its value while gold has increased 85 times. Although the stock market remains the primary wealth builder for most investors, gold consistently rises during inflation spikes and periods of global uncertainty as a hedge against currency devaluation. 3 key considerations stand out when evaluating gold's performance. First, gold has outperformed U.S. bonds, commodities, and global stocks over the past 2 decades. While U.S. stocks delivered higher returns in the last decade, gold still achieved an impressive 8.3% annualized return. Second, gold typically outshines the stock market during volatility. During Black Monday in 1987, when stocks plummeted 30%, gold remained stable. In the dot-com crash, gold fell only 12% compared to the S&P 500's 44% drop. And during the COVID crisis, while markets plunged 20%, gold declined by just 8%. Third, gold is highly liquid, second only to the S&P 500 in trading volume, allowing investors to sell quickly when needed. However, if you expect gold to consistently move opposite to stocks, you'll be disappointed. As financial analyst Ben Carlson notes, the monthly correlation between stocks and gold is essentially zero long-term. Both assets sometimes rally simultaneously, as they did throughout the 1980s, 2010 seconds, and 2020 seconds. During 2022's high inflation, gold remained unresponsive and only recently surged amid global instability and declining dollar confidence. For accurate understanding of gold's true performance, we should analyze data from 1980 onward. From 1980 to 2023, gold increased just 3.2% annually, substantially trailing stocks 11, 7, bonds 6, 5, and even cash 4. Since inflation averaged 3.2% during this period, gold effectively produced zero real return over 44 years. Despite this underwhelming long-term performance, gold excels during economic crises. From 2000 to 2009, while the S&P 500 declined, gold rose more than 14%. Even from 2000 to 2023, gold delivered an annualized 8.5% compared to the S&P 500's 7%. However, adjusting the time frame to 2009 to 2023 shows the S&P 500 up 13.8% annually versus gold's modest 6%. A fascinating metric to watch is the gold-to-S&P 500 ratio, which tracks how many gold ounces are required to purchase the S&P 500 index. Higher ratios indicate stocks are more valuable relative to gold, while lower ratios suggest gold holds more value during economic uncertainty. Historically, when the S&P 500 costs approximately 1 ounce of gold, it signals an opportune time to buy stocks. Given current economic conditions, several analysts project substantially higher gold prices. Billionaire Jeffrey Gundlach suggests $4,000 is possible. Goldman Sachs forecasts up to $4,500 in extreme scenarios, and mining executive Rob McEwen predicts gold could reach $5,000. Personally, I view gold primarily as a hedge against fear. When people worry about inflation, defaults, economic collapse, or dollar devaluation, gold prices typically rise. Currently, fear abounds from political tensions with Federal Reserve leadership to escalating trade conflicts with China and approaching deadlines on tariff pauses. But this doesn't guarantee gold's continued ascent at current rates. Historically, as gold prices climb, stocks often become relatively better values, and vice versa over decades. While gold may outperform stocks during specific periods, cherry-picking dates can support almost any narrative. I don't recommend treating gold as a replacement for long-term investing or allocating all your assets to it. Instead, consider it as one component of a diversified portfolio that provides stability during economic turbulence. A well-structured portfolio typically includes various asset classes: cash, treasuries, domestic and international stocks, real estate, and perhaps digital assets. Most financial models suggest holding between 5–15% of your portfolio in gold. Personally, I prefer a more aggressive investment approach. Given my 30-year horizon and historical data suggesting stocks outperform gold long-term, I'm generally more heavily weighted toward equities despite potential short-term underperformance. What's your take on gold as an investment? Share your thoughts in the comments below. Don't forget to hit the like button and subscribe for more financial analysis. Your engagement helps this channel grow.